Hey everyone, I'm Jeremy Zaretsky, venture partner here at Loyal VC, and happy to welcome you to this latest installment of our Growth Workshop series. Today's is entitled, What Does It Take to Get Your Company M&A Ready? All of you here probably know that M&A stands for mergers and acquisitions. And as we were talking about with our host and guest prior to the call, it's obviously a part of the startup journey that not every founder is always thinking about on a regular basis, but for many, if not most venture-backed companies, does represent one of the more likely exit paths, with others being going public through an IPO or a SPAC, possibly going into a mode where you simply take your profits and then return them to shareholders as dividends or distributions. So there are lots of different paths. We're not here to imply that being acquired and exit is the only path to liquidity for you. But Jean-Michel's focus today is going to be talking about the process and kind of thinking about and then planning through and executing a sale process for your business, whether now or in the future. And Jean-Michel is one of the 60+ advisors at Loyal at our fund. And he has a background of 20+ years in investment banking and corporate transactions involving startups and tech companies, most recently as managing director and subsequently as an advisor to a firm called Silver Peak in Europe. So we're very excited to have him today. I will turn the meeting over to him now. And please do type your questions and comments in Zoom chat, and I will surface those and bring them to Jean-Michel as we go through the presentation. We'll also have some time for Q&A at the end.
Fantastic. Jeremy, thanks for the introduction. So I'm not sure what to say. Hello to everyone, I guess, because we're all in different time zones. I'm based in London. I'm obviously a Frenchman by background. As Jeremy mentioned, I'm a tech banker by background, and I'm trying to go through the slides to get to the background, and for whatever reason, I'm not getting through.
It's possible if you've got multiple monitors that it might say your screen sharing is paused, in which case just navigate back to where you've got your actual PowerPoint and click on, hopefully it's an orange box. You can click on the green to resume sharing or resume screen share.
Sorry. Here we go. So that's much better. So
let's see if the next slide advances. There we go. Big disclaimer. All right, now we're in business.
The reason why we're here is I've been came out for many years as an entrepreneur, and now obviously as a founder of Loyal VC. My own background is, and my LinkedIn is probably out of date, is closer to 30 years of tech investment banking, mostly dealing with European companies, but obviously with counterparties globally. And you'll see some of my recent transaction sort of stuff that I'm involved in, which is obviously later stage compared to maybe where you guys are at. The whole idea of the seminar that we are running tonight, my time, is to make M&A one of your key priorities. And I know it looks, it seems a bit odd because you've just spent all your time and energy, to get money in, and we are asking you to think about, exiting. That's a bit paradoxical, but in effect, it's part of the game of bringing an investor in, because as soon as they're in, they're thinking of how they're going to come out. And if I was giving an objective for the session, it would be, from this presentation, the discussion we are going to have, if you could take away, one or two actionable ideas or items, that would be fantastic. I think that would be a job done. What we're going to try to cover today is a couple of slides on market conditions and why M&A is even more relevant than ever before. What it means from a early stage company standpoint, and then we'll go through a kind of 101 on M&A, and I can impart some of the wisdom that I've picked up over the years. And of course, feel free to chip in with comments, questions. Hopefully some of what I'm going to say or share is going to be somewhat controversial, and you'll have comments, and I'll welcome those. Now, why is it more relevant today than maybe it was, like a year or two ago? Well, it's simply, as you know, the market for venture funding has been through a tremendous change over the last, few months. Here you have a chart from one of the boutiques in the US, which is to do with the SaaS software market, and you see the valuations crashing down from 35 times ARR to 10 times, and that's for the better companies, the ones which are growing more than 40% per annum. You cannot have such a change in the market without profound implications on the funding environment. And I would argue that if anything, we've seen nothing yet. I think the upcoming economic recession, which is synchronized, happening in every part of the world as the central banks' policies play out, will have a tremendous impact on the market overall, and on your market in particular. How much money your customers have to spend with you. So what it means in practice, it means that you have a flight to quality from an investor standpoint, and that means that you have to think pretty hard in which bucket you are. Are you one of these companies which is going to be in high demand, in which case you should be relatively unscathed by market conditions, or are you just another type of companies, and in that case, you're going to find it difficult to attract investors from outside. What that means also, it means that, interval rounds are going to be very common, and you have to ask your questions, and that's the role as CEO of the business, whether you think that your shoulders are going to support you. So, that probably means that you have to think a bit harder on the plan B, maybe harder than you were thinking, a year or two ago. And of course, the chart says it all. Valuations are going to come under considerable pressure, both from a funding and a M&A standpoint. Now, if we look at what the M&A market is doing, you see a couple of things. You see that, again, in terms of number of transactions, and again, it's the software market here that we are looking at. The number of transactions is dropping, like a stone. The value of transaction is dropping like a stone. And again, if we think that things are going to get worse before they get better, there's more to come. So don't get fooled by the bigger headline transactions. Obviously, we've had the wonderful transaction, Adobe buying Figma for 20 billion, 100 times ARR. That's the exception. That's probably, not of your concern particularly. And if you look at the chart, you can understand why your existing shareholders are nervous, because they know that the exit opportunities are actually getting more tenuous. So there's a couple of things that you have to think hard about. One is obviously your existing shareholders may or may not put more money into your business, and definitely you need to have a plan B. But more than that, you need to be seen as thinking about the plan B. What your shareholders will want to see, that you take their interests at heart. So having a plan B, in my mind, is not an option. It's something that you need to have, both because you want to tell your investors, hey, don't worry, I've got it all covered, and if we can't put more money into the business, I've got a exit plan. But also, you want to respond to the fact that they may not support you, in which case you do need a exit plan. Now, what does it mean for early stage companies? What we have to realize is obviously M&A is a rational market. So there's buyers are watching the pennies. If you talk about public buyers, they're very concerned about making announcements, depending on what the market reaction might be. So they're going to be more careful. Therefore, the proclivity to do M&A is less than it was before. And they will be very cautious. And what that means is that you need to show, and is always true, but during the go-go years, maybe people can look ahead and imagine Now they will want to see, and they will want to be able to demonstrate that, you can move the needle for their business. And in theory, yes, innovation can pay off, and therefore, they would want to buy innovative companies. In practice, in today's market, what we see is that the CFOs of the approval committees, are nixing, many deals, and the best proxy for them to make sure that the innovation that you have is worth something is if you have real revenues. And real revenues, rule of thumb is about 10 million. So it tells you how much room and road you have to cover to get to safely the point where buyers will want to buy you. Now, of course, there are exceptions. We see in the headlines there are truly disruptive companies, which are the ones that are in the way of big buyers, and they want the big buyers want to take out the competition, or they want to buy disruptive innovation. But by definition, they're an exception. The more common case is acqui-hires, where the main driver of the acquisition is buying a team which is doing something interesting. But again, it's not a complete recipe for success, because they always are tempted to wait until you're in deep trouble to buy your first home. Now, rules of thumb, number one, selling with less than 10 million revenues is hard, and the consequence of this is you have to get there very prepared. Rule of thumb number two is 1 in 2 smaller companies end up with only one offer. So, think about it, and the chances is you're going to sell to someone you already know. So you have to know more. Go ahead, Jeremy.
Yeah, I'll jump in with one question. We're accumulating these from the chat and from the pre-submitted ones, but one founder attending asked, as their assessment is for their company, they expect to exit in 5 to 10 years rather than the next 2 years. But how does the current M&A market and climate affect them? How should they think about the current market conditions, as those might speak to what they should be doing now in preparation for an exit, say 5 to 8 years out?
Well, the argument, of this presentation is to say, if you're thinking that you're going to exit in 8 or 10 years, you're probably thinking about your business the wrong way. Because what you're talking about is the nominal case, where you're going to be allowed the time and the money to, take the business to its full conclusion. What we are talking about here tonight is all about, hey, if I have to exit, in 2 years, what does that mean? Who are the buyers? What do I need to do to be in a position where I could be attractive for buyers out there? Now, obviously, that's not the nominal plan. That's probably not what you will want to execute on, but that's what you want to prepare for, i.e. the worst case.
And it's interesting too, and we talk about helping founders maximize their optionality, and this speaks to that as well, in having a plan to respond to inbound inquiries or to relationships with channel partners, for example, that it may be shiftable in an easy way into an acquisition conversation. So preserving the optionality, being ready to respond or to initiate a process with relatively short notice. And I think that's an important element of this too. It may not be a discrete choice of, okay, we're entering M&A mode now, so much as we have enough knowledge of what that would entail, and we can kind of turn it on if the conditions are right, or if we learn that, for example, we're as a company are going to need a lot more money than we thought to get to the next level of growth. It might be time to look at a potential acquisition instead.
You're absolutely right. Inbound inquiries are often, the start of a process for smaller companies. And what that means is that, if you haven't prepared, then you're going to be rushing to get ready and reaching out to other potential buyers. And essentially, you cannot do good work in a rush. And what that means is that the guy who is knocking at the door has an unfair advantage of being the first, and all the others are also around. And you're going to be in the very difficult position, which, I've been through, where you're rushing out and you're not getting feedback from the market quick enough unless you take the risk of the current interest offer to disappear. And that's a very uncomfortable position to be in. And that's exactly the position you don't want to be in. And hopefully, we're going to talk about, how you're not going to get into that position.
Very
Now,
good. Thank you.
What does it mean to be M&A ready, which is exactly what we're talking about here. One thing that you need is a clear business strategy. Now, that seems to be, obvious. I'm currently running an accelerator which is called EIC Scaling Up, which are companies which have raised 10 million or more. And I'm actually shocked. Okay, these are European companies. I'm actually shocked, by the poor quality of the pitches. The companies are finding it difficult to concisely explain to the market who they are, why they matter, and why they're different. So, I would urge you, because you will need it, when speaking to potential buyers, to really have your elevator pitch and have a concise PowerPoint, a few slides, no more than 10, that you can distribute to a buyer without an NDA. As soon as you need an NDA, interest evaporates. So you need a little teaser, and it's more than one page, which is easy to digest and which goes straight with them, hit them straight between the eyes. And of course, you need to have a clear idea of what you're building, but also what you're not building. I mean, let me take an example. If you're a tech company, and someone is going to buy you because they have plenty of distribution power, you don't need an awful lot of distribution power yourself. You're going to build a distribution at a great cost for something which has zero value to a potential buyer. That's an obvious. The second thing you need is to build industry profile. And again, it's my experience that, not enough resources are spent by young companies to build their profiles. So you need to get on these league tables. You need to work the industry conferences. You need to have a lively news blog on your website. You need to get noticed by industry analysts. And by the way, you don't need a subscription to Gartner or whoever, to get noticed. These guys want, fodder to bring to their corporate, clients. So they're interested in interesting, innovative companies doing something a bit different. And the picture on the right is Joe Biden, by the way, talking to a town hall meeting with half of the, MTCs. And it tells you how it feels to go to industry conferences when you're a young company. You'll have your share of empty rows, but nevertheless, it's part of the course. And it's the way to build your presence and your visibility in the industry. The third thing you'll need is a clear exit plan, which is time horizon, possible buyers, realistic valuations, shared with the board. That, so very quickly whether you are within deal range when you speak to people, potential buyers. And the last but not least is obviously a clean company. But if you've been through a VC process, probably you have that. Now, who are the buyers? If you think about it, there are probably three types of buyers, and I'm sure I escaped some. But probably by decreasing ability to pay, you have the portfolio companies of PE funds. The private equity funds obviously have been super aggressive. They've built, a huge amount of cash, and they are very keen to deploy that cash. So they're interested in, working on buildups. It may be that you'll be on the small side, but you have to think hard whether these guys, might be relevant buyers. You have obviously the corporate buyers, and last but not entirely least is other VC-backed companies looking for complementary technologies, geographies, segments, clients. We see more of these transactions, simply because now you start to have VC-backed companies which have raised considerable amount of money. Think of SoftBank, back companies which have raised 100 million. So they can spend some of this 100 million, buying you.
One question that comes to mind from this is when you look at PE-backed companies and PE firms, where do you see the threshold being? Is there a certain revenue level? Say you're at 10 to 20. It seems like at that level, then connecting with the PE-backed companies, growth stage companies backed by private equity firms who tend to be very acquisitive and can get expansion capital, acquisition financing from the PE parent makes sense. What is the minimum sort of revenue level you see where it then begins to make sense to connect with the actual PE firms to become a platform company of theirs for direct acquisition versus being a tuck-in?
It's a tough one. I mean, the 10 million I was referring to is as applicable to these companies as any of the buyers. Having said all this, I've just done a transaction for a company which had 5 million revenues in e-commerce software, and we sold it to Planet, which is a Advent International backed company. The reason why we succeeded in this sale is because we had a damn good operational plan, which suggested that the revenues were going to double in the next year, which, by the way, they haven't. But we were pretty damn convincing.
Very nice. We'll do a whole separate webinar on how to structure your earnout, right?
Well, that's another story.
Yeah.
The earnout, we had obviously an earnout for about 30% of value. Interestingly enough, the PE-backed company was so keen to integrate the company that they decided to integrate right away, which meant that the earnout couldn't be earned.
Oh, nice.
That had to be paid. So that's obviously the value of being a small cog in a big machine. Now, when you try to go beyond the three types of buyers, you need to map out your possible buyers. And here are the tools of the trade, of bankers, but you want to do it yourself because you know your industry better than any banker. So you have to do the heavy lifting. You'll be much better at it. Use the value chain approach. That's what bankers do. That's what any consultant, will do. You would be shocked to see how many companies are not terribly articulate when trying to explain where they fit in the value chain. So use that tool. It's a great way to map out and start somewhere. And then, once you have the buckets, the different segments of the value chain, try to think of the inhabitants of these different segments and think of, synergies, M&A proclivity, how much cash they have, and whether you can access them. Do you have a route to them? And we'll talk a bit more about it. The chart is a real life example where we did a value chain mapping for an ad tech company. And it was hell, and we really struggled with it, but at least it gave us a starting point. So it can be done even in the most difficult industries. Now, that map will obviously change over time. So don't think that you've done it and therefore, next year it's the same, chart again. It will change because your understanding of who you are, will change. It will change because the players themselves, will change, both in terms of, are they still around? How much cash do they have, and so on. So, and as you meet buyers, you'll probably learn more about the industry and, how it really is shaping up. By definition, if you're doing something innovative, you're in a field which is changing shape all the time, and therefore you'll need to refresh your understanding of who you are. Now, once you've identified who the buyers are, you need to think about how to approach them, because in fact you want to approach them well ahead of a formal M&A process. Now, obviously, the golden rules of approaches is never make a cold call. So always get an intro, meet at a conference. If you must, use one of your first level LinkedIn contacts to get to an intro. but never ever make a cold call. The second golden rule is always create an impression of competition. So even if you know damn right there's only one buyer, make sure they don't know it. And obviously you want to leverage the fear of missing out. By the way, when we come to talk about bankers, that's what bankers are pretty good at, is running a process which gives the impression there's a lot of people in the process. Well, we just talked about, there's only one offer in the end, which is going to turn up. So the likelihood is you will not have much competition. But obviously they don't know it and they must not know it. The third, rule is never, ever mention price. So of course you need to know at what price you and your board of shareholders would be prepared to pay, but you never mention it until the very, very last, negotiation to a possible buyer. Because simply you may have a good surprise. They may actually be prepared to pay more than you thought you were worth. Now, that's not the normal case, but that's a possibility. And it happens more often than we think. If in my career, probably in 20-25% of cases, we had buyers, putting some ridiculous price on assets that we didn't think, would be worth that much. Now, beyond these golden rules, when you have your list of buyers, create an approach plan and start thinking about, in this category, these are the players, these are the people within the players that I want to speak to. This is the channel we're going to use to get to them. And you start allocating tasks. And by the way, that's where your board should help, or your advisory board. We'll talk to that in a second. Now, to Jeremy's point, there's a special case which is inbound inquiries. Now, these days you get a lot of inbound inquiries because you have lots of larger funds, and therefore they can afford analysts dining out to companies. And these guys are mostly here to map out industries, get information. They're not really qualified buyers. So your reaction to any inbound inquiries is to qualify the level of interest. Are they just on a fishing expedition, or are they really intent on making an acquisition, and are you a relevant acquisition from their standpoint? Now, you should use this opportunity to get to know each other, but only if you are able to organize a call or a meeting at the right level. So don't take the analyst, meeting, take an analyst at VP or higher level. If you don't feel they have an interest today, or if you feel you're not able to broker that right level of contact, suggest the call back, a bit later. Now is not the right time. You're not thinking about, selling out, blah, blah, blah.
We have a good relevant question from Jean-Lee in the audience here around how and when should you start developing relationships with potential buyers, and how do you kind of perform the calculus of figuring out the right time for the outreach, given the fact that many buyers, especially big companies, may at any point be going through a make versus buy decision. So really trying to maximize the likelihood that you reach them at the right time.
I mean, it goes back to the question, are you something that is sufficiently interesting for them, right? So that's probably, the point at which, you want to reach out. Otherwise, they're just going to ignore you. At the same time, if you think you have something, a bit special, they want to know, even if they wouldn't dream of buying you today, but they may buy you in 3 years' time, or to the point of the gentleman earlier on, in 8 years' time. So from that point of view, too early doesn't really exist, provided you have something that you think will be valuable to them.
That makes sense.
It might be early stage, but it's fully formed.
And from the title of your counterpart's perspective, James asks, what are your thoughts on dedicated heads of corporate development, so VP or EVP of corporate development?
That's great. That's fantastic, of course. Yeah,
So that's a yes. Got it.
it's a yes. I mean, VP or GMBU, if you get the general manager of business unit, you'll be so happy. More often than not, you will get the corp dev guy or the VP biz dev. The guys that the reason I mentioned VP biz dev is because these are the guys you can find at the conference. The corp dev guy you may or may not, so it's a bit more chancy. But if the analyst that is calling you is offering to organize a call with his boss, who is the head of biz dev, correct? Let's have a call. Now, if you're doing all the hard work, of mapping out these buyers and identifying who the people are that you should be speaking to, and then making all effort of meeting these guys ahead of the process, what are the role of advisors? And I've divided it, conveniently in two pockets, the advisors you already have and bankers that you may get involved. The advisors you already have on an informed basis, obviously the board members, including the non-exec directors, are a fantastic sounding board and guys that should be able to help you reaching out to some of the buyers. Advisory board members, if you have them, and if you don't, you should. Peers and friends are not to be underestimated. There may be some other entrepreneurs who know these buyers or some of these buyers, and if you have the time, go through your first level contacts on LinkedIn. I find when I go through my contacts, and I got lots of them, one or two that I haven't thought about, but actually maybe the perfect vector to get to the buyers that I'm interested in. Of course, common contact will help, and LinkedIn is a great tool from that point of view in figuring out who might be the conduit to a potential buyer. Then you have the former advisors, your existing accountants and lawyers. These are the guys, and lawyers in particular, who should be of help on any M&A discussion. Now, you have to ask yourself, and that's probably time to think that through, do they have experience of M&A? Sufficient experience of M&A? Because if they don't, maybe you need to think about, other accountants or lawyers in particular to put alongside them, or maybe replace them. So there's a whole discussion about, lawyers in particular and their area of expertise. I mean, many companies start with a lawyer, that they know, local lawyer. They may not be the best guys, to help you on the M&A side. Now, what can bankers do for you? Well, the first thing, to ask yourself is whether you're going to be able to attract the bankers and whether you'll be able to pay for them. Now, what do they bring? What they bring essentially is credibility and brand name. Sector expertise, of course, and therefore relationships, hopefully. But mostly is going to be about the brand and the process that they bring to the party and creating or sustaining this impression of competition. It's a lot to pay for just for that, by the way. But that's invaluable because that's how you get a price going up. The costs involved are substantial. I mean, minimum fee, 250K, Silver Peak, the boutique I'm associated with, is more like 750K minimum fee. So that's what these guys expect to earn at a minimum on a deal. So regardless of the size of the deal, that's what they want to earn. So that's a huge barrier to entry.
It kind of becomes like a secondary liquidation preference, right?
Correct. They get paid before anybody else. They will have, or any bona fide, banker will want to have a retainer because they don't want to be a free option. It goes minimum 20K and up. Again, in the case of Silver Peak, is 15K in dollars per month. So think of the process, for 6 months, Well, you need to have sufficient dosh, just to afford these bankers. And by the way, they will impose on you a complicated, contract that they know very well, but you'll find more difficult, to understand, which has this wonderful concept of tail, i.e., even if the process is not successful, they will want their, pound of flesh for the following 12 months, because they don't want to be used, obviously, for nothing, and then you go and do a deal, behind their back. Now, worth mentioning, alongside an advisor or as an alternative to advisor, you can have deal introducers. Deal introducers are people essentially conduit to potential buyers, and they'll take 1 or 2% of the consideration exchange just for making an introduction, and they get out of the way. Depending on how helpful and how involved they remain, the percentage will vary. And of course, if boutiques, are not interested in working with you, think of specialized one-man bands. They exist in every industry. Ex-executives, retired bankers will still have relevant contacts, and they may give you a hand in getting a deal through. So that's worth thinking about. Not just boutiques, but also individuals who can help. Now, what is a typical process? And it goes back to the question of how early should you start? Well, if we start at the bottom of this chart, this is the formal process, which is essentially 12 months. You have a couple of months where you'll have to ask yourself the question of whether you want to hire a banker, whether you can hire a banker, and bankers in the wide sense of the word, including one-man band. If you think about it, you're going to spend 1 month, identifying, interviewing, people. Then you're going to spend probably a month negotiating the engagement letter. You're 2 months into the process already. So think about it. Then you have the formal process itself, and these are not, obviously, hard and hard numbers. But think, you probably spend 6 weeks preparing, which means, checking the documentation, making sure it's fit for purpose, probably producing some more updated version of the documentation. Then you're going to spend, another 6 weeks approaching, the buyers, and that assume that who to approach, and agree the NDA. Don't underestimate how long it takes to agree NDAs, because you'll have to deal with the legal department or the general counsel of these buyers. And some of them are very big houses, and it takes, 3 weeks to get that through the department. Think about it, another month, for first meetings, and you're doing well. First meetings, 1 month, you probably won't have to have more than 10 meetings, because you've got a business to run as well. A couple of months for follow-on meetings, assuming they're interested, they want, another meeting and another meeting, you'll have at least 3 meetings. And then they'll probably get to due diligence. And there is this question about, whether you want an LOI before or after the due diligence. I tend to let the buyers, do the due diligence, before we get into the detailed LOI, because I'd rather have an LOI, forged on the basis of knowledge, and therefore they have fewer reasons to change their mind.
And is it fairly safe to say that you recommend minimizing the legal and transactional friction, so you push the NDA until a bit later in the process? Do you typically ask for the NDA to be signed prior to starting really meaningful diligence when you get into the data room and such?
Well, it depends. It depends how hard the property is, how many buyers we think we have. So basically, how strong we think we are. If we think that we are reasonably strong, then I'll get the NDAs sorted out on the back of the teaser. So this 10-page presentation we were talking about, and that in itself is a great way to quantify the real interest of the buyer, because the reality is, a motivated buyer will sort out the NDA, and within 3 weeks, there's no question, they don't have any excuse. The a buyer was really fishing for information or just is, not that interested, won't get that done. So 2 months later, you're still, at the NDA stage. So it's a great qualification tool. And
Makes
obviously,
sense.
from my point of view, the M&A point of view, you have a big funnel. Think of it just like any other sale, and you want to go through stages and reduce the size of the funnel, as you get more qualified interest. And obviously, eventually, you will want an LOI that you can sign. Now, I put LOI with a S in bracket because, as we've seen before, one operation in two will end up with only one LOI. And obviously, it's quite important not to tell lies, but at the same time, hide the situation from the buyers. If they have any whiff that they are the only game in town, they will, of course, reduce the price. They will find an excuse. By the way, remember when we were talking about the private equity, buyers or portfolio companies of the private equity, there is a bunch of bottom fishers in that bucket. Constellation Software is a great example.
Interesting. I've talked to them before. Yeah.
Yeah. These guys are super helpful on M&A processes because they're in the business of shooting offers, which are lowball offers, awful offers. Then you can say, I've got another offer. They don't have to know that the offer is a third of the price that they have offered, put on the table. It's great news flow. It's a great line. And by the way, that's how we got 10 times revenues, on this e-commerce software company I was, referring to. We had an offer from, I don't think it was Constellation Software, it was one other. But, it was an offer which was literally, actually a tenth of the price.
And anecdotally, my understanding too is that those kinds of specialized buyers that do a lot of transactions, even if they are kind of really value shoppers, many of them can act very quickly in being responsive to an initial approach and generate an offer, which could increase your leverage if you have, like you alluded to earlier, one good offer and want to be able to have some optionality and competition there.
Correct. They're pretty quick at shooting offers, but then they go in very detailed due diligence because that's the way to get back at the price, and that's really part of their DNA and so on, which is great because it means that it gives you enough time to talk to other in the market.
Right.
So if you think about it, the process I'm describing, and obviously a couple of months to complete, which is getting the cash in the bank, you have a 10 months process right there. Now that's I think something that people don't think about hard enough. Everybody has a sort of 6 months process in mind, but 6 months is for when things go right, and you're a hot company and people want to get things done. In fact, there are, deals which happen in less than 6 months with little, due diligence. Now, if you then backtrack and you think, okay, then assume that I know, the parties that I want to involve, and I know I need to know the parties I want to involve to choose my advisor, if there is an advisor to be involved. That means that you need to do all the rest before. And that's the first part of the chart. And I would argue it's going to take you another, probably best part of the year, to first prepare the company, which is this, clear business strategy, industry profile, exit plan, clean company. And right there, it's a year's worth of work. If you want to start meeting, buyers at industry conferences, for instance, probably industry conferences have a year cycle to them. So you need to think, well in advance if you want to take advantage of this, device. And then if you want to start the process itself, which is make sure that you have thought through all the points which are important to the banker, because it's part of the way you attract better bankers to work on your case. Well, you need to have worked on your pitch, with obviously the M&A in mind. You need to have worked on your map of buyers, because bankers, if half the work is done for them, are much more likely to get engaged. And obviously you want to allocate the responsibilities because you cannot do it all by yourself. So you want to engage your board with you. You want them to do some work for you. And that's the way you should manage your board. So again, another year is just an indication. It's notional. But what I'm saying is the formal process itself is a year. But if you really are serious about, this process, you probably have another year before to prepare for it. And that's something which, is hard-earned real life experience for smaller companies. And that assumes most of you. So that's super important. So if I try to recap what we've talked about, and then we can have obviously questions. Funding is becoming real difficult, and is going to get more difficult, not less. Don't believe what you read. M&A is back to reality valuation-wise, so it's not going to get any easier. Most smaller companies sell with difficulty anyway. So that's a fairly grim picture. So what that means, you need to spend more time to prepare, and therefore it's never too early to prepare. Mapping is a very powerful tool to identify potential buyers, and you're the best people to think through, who the buyers might be. By the way, the chances are for smaller companies that the buyers you already know, there will be the resellers, the OEM partner, guys that you have met, before. But there may be others that you haven't, that you should. And the dialogue with buyers should start well ahead of the actual process. They need to have you on your radar screen because, by the way, it's not so different from investors. They will want to have a familiarity with your services, your product, with your company, your team, before they make a real valuable offer. If you ask them to shoot in the dark, the chances are you'll get a crappy offer. Identify your advisors early. So think about this, can I work with the advisors I currently have? Do I need to hire bankers? If I need to hire bankers, who might they be? I should meet them. It takes some time. Obviously, bankers are busy guys, and it may take some convincing to get them to work on your case. Bottom line of all this: think of a year process, formal process, but probably another year to prepare. So, if there is a takeaway from this little discussion, is hey, you need to think about M&A because the market is tough and is going to get tougher. Second, it takes quite a lot to prepare, and it's you who need to prepare. Don't think that the bankers are going to solve it for you. Naive and common view is that I'm going to hire bankers and they're going to sell my company. Well, they don't. What they do is extract a hefty amount of money for lending their brand name and running a process. But in terms of the actual thinking, a lot of it is going to be yours. So that's what I wanted to share with you today.
This has been fantastic. Thank you, Jean-Michel. A few more questions that I've got in my the buffer here from things that founders submitted ahead of time. One I wanted to jump in with first is what do you see the typical valuation multiples as a really rough ballpark being for sub 10 million and then above 10 million companies? Do you have any rules of thumb when you're trying to frame expectations with a founder before they engage with a bank?
So first of all, there is a premium to size. So you'd rather be big and ugly than small and cute. That's, no question. Second thing, if you're a smaller company, you really have to think hard whether you'll be selling the innovation, the technology, the IP, the patents, or whether you're going to be selling revenues, the team, the infrastructure, and depending on what you're selling, the multiples are going to be very different. Anything which is, real about IP and patents and all this can get, big multiples, think about, 5 times, 10 times, revenues. And that assume that you have revenues. If you're in deep tech, obviously, you may well be, below the radar in revenues. If you're a service business, then you're going to be sold, on much smaller revenues, and often, if dare I say, on profits. So, think about, having revenues as its challenge, because if you don't have revenues, at least people can't, value you on the basis of multiple revenues. They'll have to make a decision on how valuable the technology is. As soon as you have revenues, they will be tempted to put a multiple on revenues. So that means that you have to have substantial revenues to be of real value. And if you're a services business, clearly the multiples are going to be quite different. I'm getting around the topic because I'm not mentioning numbers, but part of it is the numbers tend to be dependent on which vertical you inhabit.
Which makes sense, and also the that kind of curse of being post revenue is something we see, as founders and also as investors at Loyal, where we rarely invest. We rarely make follow-ons in companies that are still pre-revenue. It does happen once in a while, but many, if not most, of our pilot investments, the 10K stage, many are at the beta level. They could have a little revenue, it could be pre-revenue, but when we're doing follow-ons, the companies are almost always post into relatively significant revenue. So it's a similar dynamic where the valuations are a lot easier to understand and rationalize when there is some revenue, but that first dollar of revenue could actually cost you in working, especially in an M&A context there. So something that's interesting dynamic to consider. In the case of, for example, the acqui-hires you alluded to earlier, do you see those valued based on number of headcount acquired? Are there other metrics that tend to come into play there?
Yes, you see that in specialist market where the job market is very tight. So, for instance, engineers, you see some multiples, how much you should pay per engineer hired. In the go-go years, it could be 1 million per engineer. So you have 10 engineers, fine, 10 million. Now that assumes they do something very innovative, groundbreaking, and you're truly at the innovation front. So, for instance, artificial intelligence, AI, was one of these areas where there was a battle for talent. I don't think that today, in today's market, people would be prepared to pay as much.
Good to know.
We've seen that.
Good question from Bogdan in the audience. So, does an exit always mean you're selling all of your shares? What about situations where founders continue to be on the board or retain a minority position post-transaction?
So, if you're dealing with a corporate buyer, it's unlikely. So they will want to keep you in a different way, through an amount. If it's a public company, you will have a share, but it's a very, very small share by definition. So you participate in the employment ownership program. You can have a private equity fund which recapitalizes the company and let you keep some percentage of the company. They will probably want to have a fairly clear plan of selling down or selling together, over a period of time, and assume they would be pretty tight on this. So it can happen. It's not the most common.
We'll wrap with one final question from one of the founders in the audience. Does selling a startup early, and that's subjective, of course, mean the founder wasn't confident in their ability to scale the business? How would you address someone who says, well, I could sell, but to me, I view that as a failure relative to my original goals?
Well, I think there are two things, and I don't want people get confused after to this talk. One is planning for the worst and be ready, and one is pressing the button. If you have to press a button, is by definition a diminished, a degraded scenario. Your investors didn't want to put more money into the business. You haven't been able to raise money for the business, blah blah blah. So by definition, something is not going quite right. And rather than packing up and lose everything, you're going to try to do something with it. Now, from a process standpoint, if you get to that point where you have to talk the market far too early, it's not obviously the best position to be in, and you'll have to put some lipstick on the pig to make it look nice, to a potential buyer. And by the way, it's part of the storytelling, which bankers obviously are very good at. And the only thing you need to do, remember, is just create the doubt in the buyer's mind. Is he missing out on something that one of his competitors might buy? What you don't want is the buyer, being 100% convinced that you're desperate and you have to sell. So even if you're desperate and you want to sell, obviously you don't want to let it on. And that's part of this, storytelling and process and impression and competition and all this.
So really maximizing the FOMO there.
Yeah, absolutely. Absolutely.
Mm-hmm. I've often found across different aspects of business that most people are more motivated by FOMO than by greed, which is surprising. Before I got involved as an operator and an investor, I would have thought it was kind of split 50-50. There's the greed group and the FOMO group, but I think FOMO is winning out 3-1, at least anecdotally in recent years.
I agree with that. Don't forget, when you're talking about buyers, you're talking to operators who are very concerned about their own job. They don't want to make a mistake. That's their main concern. Greed is not actually a key driver unless you speak to a principal who has really skin in the game, and therefore it makes a real difference. So if the buyer is an owner own business, of course greed is going to be super important and they're going to be pretty tight. If you're talking to Mr. Big Corporate, FOMO is more important.
Very interesting. I think that perspective makes a lot of sense. We are out of time. Jean-Michel, thanks for a fantastic presentation. Thank you to all the founders who attended and put in some excellent and relevant questions. As always, we'll go ahead and compile this recording and post it to the Loyal website at loyal.vc/workshops, and be on the lookout for the invites to the next workshop. We typically do these at least once a month, so we'll hopefully have something on the calendar for you for November. And yeah, thanks, Jean-Lee, for all your great questions as well. And again, thank you to everyone for attending, and Spencer for helping organize, and my colleague Cassidy as well. And we'll go ahead and stop the recording here. And everyone have a good whatever.